Hello and welcome to Switzer Super TV. I'm Peter Switzer. This is my colleague Paul Rickard. Hi Paul.
Hello Peter.
Let's talk about 2014. Looked terrific until September. Then iron ore prices went down more than expected. The dollar fell, took foreign investors out of the Australian stock market. But oil prices really confounded everybody and took us down even further. But if you look at it, it wasn't that bad a year.
Look, I think you're right, Peter, and we'll come to some of the data in a moment. But look, I think a couple of key investment themes just came through 2014. First of all, we had a stronger US market, we had lower interest rates, and they stayed low in Australia. We also had a weak Aussie dollar. I don't think anyone saw the oil price falling out of bed.
No.
But you're right, our market didn't do a lot on paper. If you look on the screen in front of you, you can see a graph of the S&P ASX 200. Basically finished up pretty well unchanged. However, when you peer into the data behind it, which we're now showing, you'll see that the price index, which of course just measures the simple movement in prices, was up 1.1%. You look at the accumulation index that actually adds back dividends, Peter, up 5.61%. You adjust for the benefit of franking, and that's a return closer to 7%. So 7% is a lot better than 3.5% in term deposits.
Exactly. It's basically a tale of two halves, Paul, isn't it?
Yeah, it is, and that's the other part of what this data shows you. We've also got there some components of the market, the top 20, the mid-cap 50, which is stocks number 51 to 100, and also the small order stocks numbers 101 to 300. Basically, the top three, few top of the stocks did okay, the middle part did really well, and the bottom part did pretty poorly, and that's what the numbers show you.
Okay, so what about the sectors for over 2014?
On the screen in front of you, you can see the 11 sectors that make up the S&P ASX 200, their relative market weight, their price index returns for 2014, and the return if you add back dividends, so-called the accumulation index. The standout is that the so-called yield sectors, Peter, did really well. Financials, utilities, telecommunications, which is largely Telstra, and property trusts. They led the market. They were four of the best performing sectors.
And banks, they were bagged with all the other yield players for this year, weren't they?
Well, a return after dividends of 9.84% for financials. I mean, we were people saying not to de-weight, but certainly a lot of people out there suggested you need to get out of your banks. That's not what the market did. It actually bought them, and of course investors continue to really appreciate the yield that banks provide.
Okay, let's talk about energy.
Well, energy got punished with, of course, the fall in oil prices, and we also saw that reflecting in the materials sector, which is largely your iron ore miners like BHP and Rio.
Okay, healthcare?
Healthcare was one of the stars. Superb performance in Australia. Followed a similar performance in the US, and I think it was really a function of investors globally recognising two things. One is that the demographics are so much in favour of that sector. But also in Australia's case, we have some of the world's leading healthcare companies.
Yeah. I was disappointed that the index didn't do as well as I liked, but I was really happy to see the kind of stocks we support, yield stocks, did really well this year. I think that's the good story of this year. Yeah,
I think even despite the sort of the 1.1% return, as I said, if you back the yield sectors, which many small investors did, you just have to say that 2014 wasn't a great year, but it wasn't that bad a year.
No, and our next program will shine the spotlight on what we think will happen in 2015. Thanks for joining us on Switzer Super TV.